All right, we are recording. I'm looking at the sound level. Adjust that a bit. Negative 8.7 decibels. Sounds about right. All right, what are we looking at today? We're actually getting close to the end of the series. Of course, it's still in the works. So, the last concept we looked at was the failed to return. FTB, I forgot what that meant. Actually, I'll look at my notes. Let's say failed to return. First time back, of course. Ha. Well, that's why we take notes, because you will forget. Okay. So, alright, and I think I did preview the first video for this high and low probability trade analysis. So he just lays out, it's like 10 cases that you may encounter as you're looking at the charts, and he gives some of his thoughts on how risky they are and what factors to consider when assessing the risk. So I'll recap that video. Okay, this is something I want to draw attention to, is that even though this first case may not be an ideal trade setup, you may still want to trade it, but you can just use lower risk, either by using a smaller stop or by using less capital. So if you wanted to risk 1%, and if you're using 10x, then your stop loss would be 0.1% under your entry, or above your entry in the case of a short. But if you wanted to reduce that by half, you could use a 0.05% stop, or you could use less capital or less leverage, whatever you want to do. But there are ways of reducing your risk. I am just in a great mood today, which is surprising because I didn't get that much sleep last night. I don't like that he uses arrows to mark out lines. It's a matter of personal taste. Because I don't see the directionality. Why does it need to have a direction? Why can't it just be a line? That's all I'm saying. Okay, I think I'm ready to walk through this first case. We don't have too much to work on, so it really helps if you slow down and try to see what he's saying. So I identify when you're looking at a potential trade, 3 steps. So first you identify the structure, and I'll bring All right, so what was I saying? So first, 3 steps. Identify the structure. In this case, it's a consolidation in a small range, as I say here. And we say a small range because this implies that whatever the price was doing before, it was moving in a much larger way. So case 1, 2, and 3, we don't know how price is, or what price was doing prior to this, because it doesn't really matter. All that matters is it's a small range. So there's risk right there. That's one risk factor. What else can I say about the structure? Almost equal highs and lows on both sides. So we have these equal highs and these equal lows. It's a small range. And what these equal highs and lows represent is waiting liquidity. So these are both price magnets, pulling price for the eventual break. So it could break up, it could break down. No clear stop loss hunt in either direction. Yes, so there hasn't been a deviation in the range or anything like that to absorb the liquidity. So it's still there waiting. The second step is to identify a setup. And the setup in this case would be your breakup structure, your breakup structure setup. He just says more generally, internal structure breaks before the major liquidity sweep. And the liquidity sweep will be, absorbing the equal highs and the equal lows. So we're looking for, standard stuff. I guess there would be an imbalance down here. So you would have the standard order block waiting here. You have the imbalance. So, those two together, it's a potential setup. And the third step would be to assess the risk. So when would we know if this trade was moving against us? And in this case, it would be the low of this swing. So this higher low here, because that would be a market structure break if price came down and triggered that. That's why we have to set such a small stop loss, is because in that eventuality, if price did move down, then it would be heading towards this waiting liquidity, which would not be good for us, because price starts to move down that way, and say you're like, I'm just gonna double my stop loss size, I'll make my trade more secure. You're not actually making your trade more secure, because if it wants to take out this waiting liquidity, it's going to take out that waiting liquidity. So you would just be losing twice as much money, So he identifies this as a low probability trade because, we have this small setup that we could take if we wanted to, but there's no clear intention in the market or the price action. Yeah, so that is case 1. Let me throw that into the notes. I hope that made sense. Makes sense to me. Or at least I think it does. So. Oh, we forgot our arrows. We need to draw in those arrows. You get an arrow, or do you? You get an arrow. And you get a very small arrow. Much better. It's much better. It's magic. Okay, let's move on to the second case. Okay, I want to say real quick that the size of the stop loss as a percentage of the of price movement should have nothing to do with your risk. So if you have a 1% risk per trade, you just have to adjust other factors like how much capital you're using to achieve that same level of risk, even if you have a larger or a smaller stop loss. Yeah, so just keep that in mind. Trade or not? He's like, picture Shakespeare. To trade or not? Okay, this is very exciting. We're bringing in a new emoji, the target emoji, to help us better visualize what it is that we're aiming for, as far as what specific level we expect price to go to. I don't want to say low risk because we're using low in a different usage, as in low probability or high probability, so I'm trying to mix things up. So we'll say minimal risk. Okay, I think we can walk through the second case as he lays it out. Once again, our 3 steps. We have identify a structure, or identify the structure. I might change that. In this case, it would be a high time frame demand zone. This could be an order block, breaker block, mitigation block, a major swing low that's already been hunted. He had that drawn in as a line. I won't include that, but that would be from this bottom here, back somewhere over here. So the liquidity has already been taken out that area. Let's see. Okay, so that will act as a support for our trade. That kind of discourages price from moving against us. So now we identify the setup. Step 2, the setup would be a market structure break with waiting liquidity and imbalances, or an imbalance, as the target. That's why we use our little target icons here. Yeah, so market structure break creates an opportunity. It tells us that something's going on with price that we might be able to use. These equal high create a liquidity zone that is likely to be hunted. And of course, good old imbalances are always price magnets. I don't have the magnet icon, but I very well could. So that would be the setup. And then as we're assessing the risk, the third step, I say minimal risk, just because he said it, but also because it does make sense that if we have from a higher time frame, and remember, the higher the time frame, the more weight the structure will carry. So this is a heavily weighted demand zone. So we're kind of confident that the price won't just break through it willy-nilly. Yeah, okay. So, and then of course our price targets would be, I don't know, the liquidity hunt and the imbalance. So that is case 2, and we see this is a high probability case where you could use your normal risk of, say, 1%, or you could even use a little bit more risk, depending on how confident you were. So let's drag this into the notes, and then we'll move on to case 3. We are just trucking along here. Hour and 13 minutes. I'll zoom in on this. He says, your risk depends on the clarity of your setup and possible previous price action. I need to turn up the music. That's too good. Okay, I think I'm ready to walk through case 3. Now, just like in case 2, we start off with a high time frame demand zone. That could be any of the things I mentioned before. But what makes this one different is how price unfolds after it hits the demand zone. So we have a market structure break, followed by a break of structure. Normally this would be a good thing, and we would look for an imbalance before the break of structure, as well as maybe the order block down here as our entry zone to get into the trade. But what Kaplan points out as things, oh, I should say the price target would be the open liquidity level here. But anyways, what makes this trade different from the previous trade, which was a high probability trade, this would be a low probability trade, is the risk factors. So we need to be aware of the two main risk factors that are affecting this trade, and the first is the equal lows. So this suggests a liquidity level that could be hunted, as well as an imbalance that was formed before the break of structure. So we have these two risk factors that are below our long, and they pose a threat to our stop, because, well, price will be naturally drawn to them. A better trade to place, if you had the patience, would be down here in the demand order block, or the imbalance that creates the market structure break. So yeah, in this case, things look positive at first, but little things like the equal lows and an imbalance down here are not favorable. So I like to add spaces between the parenthesis and the character that follows or precedes it. I just think it looks cleaner. Give it some space, that's what I'm saying. Okay, where's my mic? Get up here, Mike. I think I'm ready to walk through. I think this is case 5. This is 5. Oh, case 4. Wow. Okay, yep, I'm ready to walk through case 4. And just as in the previous two cases, we have a high time frame demand zone, which kind of forms the foundation of our trade setup. So going over to my notes. Identify a structure. Okay, we have the strong demand area and high time frame. Price reaches the strong demand area. That would happen about here. And a good example of what would form a strong demand zone is a swing failure pattern on a higher time frame. So I took the liberty of mapping out what that would look like and how that would chart over the lower time frame is which we're trading, and then the higher time frame we would have these swing failure patterns. So let me grab that and I'll drag it up over top. No! Move the active layer, come on! Alright. So, to the left of the area of interest, there would have been some kind of low. This could have been, you know, break of structure, break of structure, break of structure. Oops, what? It turned around. Okay. And then we're coming down to it again. And rather than having a regular break of structure down here, we have the swing failure pattern. So we have this little tiny body and the big wick comes down, and maybe it goes a little bit lower than the previous lower low, but it doesn't close below it, creating the swing failure pattern. And this would tell us that the liquidity in this area kind of has already been absorbed. Yeah. So that would be one way of giving us a demand zone which we could rely on in the lower time frames. So let me drag that back down because it's hideous. It's in my way. So proceeding with the trade, we identify the setup. And in this case, the setup would be the liquidity pool formed by the series of lower highs. So we have all these lower highs coming down, and each one of these becomes a target for price to move back up to. And when price does start to move back up, you can see it moves back up in one fell swoop because these lower highs, they act like dominoes. So there's kind of a chain reaction. So one falls, and then the next one falls, and you know, it's just cascades or whatever you want to call it, all the way back up until we find some sort of resistance. But we don't need to worry about that because this imbalance formed on the way down would be our price target. So that's what we would be aiming for. And our entry would be an imbalance caused by price reacting to the demand zone down here. And he doesn't try to get down to the demand order block created by the market structure break. He's just happy with the imbalance, I guess. And that works just fine. So, let's say risk minimal. Do I have any other notes on that? No. Let me zoom out. Is there anything else I wanted to say? Nope. All right. Let's move on. Let's give this a title. Drag it into the notes, and then move on to number 5. Wow. So we've only done 4, and we're already at 2.5 hours, and there's 10. So we might not finish today. Plus, I got a bit of a headache coming on. I don't know what it could be. It could be like 20 cups of coffee I've had today, or what? Who knows? So. Alright, we're at 3 hours. I think we'll call it a day. Because we have a long way to go. Many miles to go before we sleep. Isn't that the poem? The woods are lovely, dark and deep, but I have promises to keep, and many miles to go before I sleep, and many miles to go before I sleep. So, we'll call it there.